Good morning, my name is Carl Williamson. It's January 2023 and I'm speaking to you from our London offices. I'm the manager of the Nexus Global Solutions Portfolio and the Nexus Global Dynamic Portfolio. In December, the Nexus Global Solutions Portfolio was down 2.2% and the Nexus Global Dynamic Portfolio was down 3.9%. That took the returns for 2022 to minus 14.1% for the Nexus Global Solutions Portfolio and minus 11.9% for the Nexus Global Dynamic Portfolio. Despite the fall seen in December, equity markets closed out 2022 with a positive quarter as investors took solace from a moderating interest rate environment. Solutions was up 3.2% in the quarter, while Dynamic was up 2.1% in the quarter. In US dollar terms, global equities returned around 10% in the quarter, although were still down by around 20% for the year as a whole. Currency movements did dampen these returns for a sterling investor in the quarter, as sterling appreciated by around 8%. However, for the year it was still down by around 11%. In December, the Federal Reserve, the Bank of England and the ECB all put up interest rates by 0.5%, which was a slowing in pace from the 0.75% increase we saw in November. The increase in interest rates saw rates at their highest levels since before the global financial crisis, with interest rates finishing at the year at 4.5% for the Fed funds rate, 3.5% for the Bank of England and 2.5% for the ECB refinancing rates. Japan, perhaps the last bastion of ultra-accommodative monetary policy, also caved to market pressure last month when it relaxed its policy of suppressing long-term bond yields. China has abandoned its zero-COVID policy and many of the measures designed to contain the disease. This news was cheered by investors and stock markets in the region have rallied. While there is little doubt that China adopting a more pragmatic approach is good news for the global growth outlook, there will undoubtedly be bumps along the way. In Q4, further evidence mounted that corporate profits, at least so far, are holding up better than many had expected in the face of tighter monetary policy. Gauges of economic activity are softening, but overall the labour market remains robust. At this stage, financial markets are pricing in a growth slowdown, or a so-called soft landing, as opposed to a deeper recession in 2023. Overall, 2022 was a challenging year for investors, with the dual decline in both bond prices and equity prices, something we've not seen in a generation. High inflation and the resulting central bank measures saw a sharp derating in many asset classes. Growth shares were hardest hit, with a number of well-known technology companies falling between 30 and 50%. In the early part of 2023, we expect volatility to continue. However, thereafter the outlook becomes more favourable as central banks reach the end of their monetary tightening cycle. Higher bond yields now provide an attractive alternative for income investors, and for those multi-asset investors we think they do provide a diversification after a very challenging 2022. Global equity valuations are now near their long-term averages, and in time we do think investors will look through the short-term economic challenges. The US retains its premium valuation, but we think other regions of the world do offer recovery potential. It's been my pleasure to speak to you. Happy New Year, and I look forward to speaking to you next month.